Hi, everybody. Dan Weisskopf here, ETF professor, co-portfolio manager of Block, and also lead ETF strategist for the ETF think tank. I know that's a lot of titles, but lots of fun every day. Thank you for joining us. And it's live at 5:05 today, as opposed to 5. We're just running a little bit late. So glad that everybody's joining, and I see some of you coming in. Looking forward to a great discussion with Julian. And with that, I'm going to hand off the mic to David, as I always do, and we'll get started here.
How's it going, everyone? David Chikansky here. Very excited for today's show. Julian to talk all things macroeconomics. Hopefully, he'll give us a very clear picture of exactly what you can expect in 2024.
No pressure on David. Thank you very much.
No pressure at all. No pressure at all whatsoever. But with that, I'll kick it off to Cynthia Murphy.
Hey guys, welcome to Get Think Tanked. I'm Cynthia Murphy, head of research for the tank. I'm excited to talk about something other than Bitcoin ETFs after 4 days of nothing else in the world seeming to matter. So welcome, Julian. Why don't you introduce yourself? Tell us a little bit about what you do, your experience, and why we're all here.
Well, thank you very much, everyone. Well, I've been in this business far too long. I think together with my colleagues, there's sort of half a dozen of us basically within MI2. And we launched the business 12 years ago. And the idea was to try and essentially affect the same decision-making process that you would within a macro trading shop. So we sort of start off with a sort of top-down view of the world, be that inflation, growth, whatever. And then we try and look at markets, how they're positioned, whether what we think is about to happen using our models is factored into markets. And if it isn't, how are people positioned? And then we try and suggest trades to people. We're not really interested in pontificating about economics. I don't have a overly high opinion of many economists when it comes to calling markets correctly. And so we're really in it to try and make money. And I think we figured it out the other day. We have like almost 180 years of a collective market experience within the group. And, we've traded a lot of instruments. A couple of my colleagues have managed very large portfolios. So we really do it properly. We like to think when it comes to managing trades and managing risk.
So does that mean that you're very opportunistic, or you definitely have a view on? So, as David said, you're going to tell us exactly what's going to happen in 20.
Yeah, obviously, yeah, because it's always bloody easy, Dan, to wake up every. I do think to myself occasionally, I could have picked a slightly easier job than trying to wake up every single morning and be ahead of the global financial markets when it comes to causing the direction. So no, we anchor a view pretty much based upon the sort of macro. That gives us a directional bias. And then, it depends whether we think there are opportunities in the market based upon that. I mean, if stuff is all factored in, it's kind of hard to be a contrarian, right? And it's hard to find that decent risk reward trade when you think that stuff isn't factored in. I think that's when things get a little bit more interesting.
Can you define factored in? Because I think you mentioned earlier both macro and also almost like sentiment. So are you? What do you consider priced in that?
Well, I mean, look, I go back to say 2021, right? I mean, 2021, our models started to pick up really extraordinary levels of inflation coming through. And we made some very bold calls. I had some quite intriguing conversations in the first quarter of 2021 with my client base, where lots of expletives were swapped about what an idiot I was making some of these calls. And the reason why they made very, great deal of sense to us is because you were just not pricing in hikes, you were pricing in cuts. And the bets were completely asymmetric at that point. And it was pretty obvious that sentiment, judging A, by the calls we were having, B, looking at certain surveys that we like to follow, were completely the wrong way around, based upon our view of the world. And so that's when you can kind of go, all right, all on black, right? It's a decent risk reward trade. I think part of the issue last year was only really in the middle of the year, end of the second quarter, did you have some of those trades set up again into that sort of degree of sentiment again?
I'm going to put you right into the hot seat and say, well, the only thing people are not betting on today is that rates just stay the same.
Yeah.
Is that the contrarian bet you see right now in the landscape?
I think it's unchanged, let's say largely unchanged, right? I think David, one's got to be realistic. For whatever rationale, I think there are explanations. I don't want to get too Machiavellian about it, but I think there are reasons. Central banks are probably going to cut. I'm not sure that there's any justification for it, particularly in the United States. I think there's justification in continental Europe. I think there's maybe justification going to show its head in the UK. I don't think there's any real justification in the United States, but they are going to cut. The question is how much they are going to cut and what is the policy framework that they are pursuing? Because I think the market doesn't understand either of those. My understanding from policy friends that I have used to work at a very large policy shop at the beginning of the I guess it's the century. They are pursuing this policy framework, which was last pursued by Alan Greenspan in the late 1990s, and it's referred to as opportunistic disinflation. That it's one of two options that you have, and it's certainly the most pleasant when inflation hits the level that it hit. The other one was deliberate disinflation, which is what Paul Volcker pursued. Now, deliberate disinflation is exactly what the name suggests. They deliberately create disinflation. And how do they do that? They basically shoot the economy through the forehead, right? They kill it. And the way that they kill it, and the best analogy is you walk the economy into the swimming pool in the back garden, you stick its head under the water till it drowns, dead, deliberate, gone. You got your deflation. Opportunistic disinflation is a trade-off, and it's by far the nicer trade-off, but it is a trade-off. So you don't drown the patient, but you stick the patient's head into the water to the point that it splutters, right? Now, what you hope is that you get some exogenous event come along, the ideal one, the get-out-of-jail-free card being productivity. And productivity drains the water out of the pool. You still keep your hand on the head, but the water is drained out. But you have to keep your hand on the head for quite a long time. That's what higher for longer is about. Now, you hope, as I said, the productivity comes along. But what it is because you've never drowned the patient, it isn't a normal easing cycle. The easings that you get are really fine-tuning, right? They're fine-tuning to stop real rates getting, say, too tight that you think you're going to do real structural damage to the economy. And that's exactly what Greenspan did. Greenspan eased, if you look at a chart, Fed funds in the early 90s or the mid-90s, he pushes rates up, they hit a peak in early 90. He then holds them there, he cuts 25, I think, in July of 95. He cuts another 25 in DEC, and then he cuts another 25 in Jan of 96. Then that's it. For the best part of 30 months, unched. You've never taken them so far that the patient drowned, so you don't have to try and give the guy mouth-to-mouth resuscitation, right? All you've got to do is kind of keep your hand sort of there so that you grind out those inflationary pressures. So I don't think the market understands that. That's why they've just assumed that this is a normal easing cycle, right? And we've got so used to these hyper-benevolent central banks that are our best mate. We forgot the old, central banks of old who used to come along with their jackboots on, notably the Bundesbank, and kick you in the nuts, right? I think this is really, that's the first misunderstanding they've got. We don't understand the policy framework. The second problem is you've got a bunch of central banks who seem more gangingly desperate to achieve a soft landing, particularly in this country. And I think the election has an awful lot to do with that, than they seem to be willing to grind out inflation and take the pain. Right?
I heard that the reason why the Fed was actually talking about rate cuts now is because they didn't want to do it like after, they didn't want to first signal it after like all the presidential economic events like begin.
David, they shouldn't even be talking about them.
Yeah.
Core service inflation, if you strip out energy, is still above, is 4%. Right? But the Bank of England actually came out the other day and made it absolutely plainly obvious that they don't think we're anywhere close to a level where of core service inflation. It doesn't matter goods, right? Goods, traditionally, we've been in global goods disinflation for the best part of 400 years. Right? That's what productivity does. Right? Goods inflation should be running at negative to 1%. Right? That's what it does. Right? Service inflation, though, shouldn't be running at 5 or 6. That's what determines what your core inflation is, right? So the idea that we're even contemplating rate cuts is nigh on absurdity, let alone the concept that the market is run with, that this is some sort of normal tightening cycle. And it's not that, because the Fed's penciled in exactly what they did in 95, 96, 75, right? And if you notice in the SEPs, that's predicated on higher unemployment, lower growth, right? They talk about things that aren't just inflation. They talk about aggregate demand, weakening labor markets. Well, they're not getting those. Nominal GDP looks set to be again 6+% this quarter. How the hell do you ease rates with 6+% nominal GDP? Because even if inflation went down to 0 tomorrow, we have no workers. So suddenly we have 6% nominal, 0 inflation, and 6% real? How do you do that without creating inflation? What do you think wages growth is going to be when you try and grow at 6% and hire all those workers that don't exist? There's only one time really in post-war history where we've tried to punt an economic cycle from this level of unemployment, and that was the late 1960s. And it looked like we had Goldilocks for 9 months until inflation exploded again.
So I think what you're saying is higher for longer, right?
I think that, yes, higher for longer. I don't think the Fed certainly doesn't envisage 100 and 200 basis points of total easing, which is what we got priced into the curve, basically. Okay? They're thinking they'll adjust it. And I don't even think they should really be adjusting at all, because I don't think the data supports that, because if anything, I think there is a danger that the data is about to re-accelerate.
And when you've got higher for longer and you've got a service economy that's dependent on wages, right? Who raises their hand and says, I want to get paid less?
Well, no one does. But this all goes, here's the other problem. In the United States, we have this, horrendous economic reality. And that is that the financial markets lead the real economy, not the other way around. The equity market, if you look at the correlations, leads employment by 6 months.
But interest rates will not affect the desire for more service workers, right?
No, that's it. But here's the thing, David, if the equity market leads the employment, right? And employment dictates nominal GDP, right? Because it's basically what it does, right? If you take how many people are working, how many hours they're working, how much they earn an hour, you get this series called aggregate weekly payrolls, right? It's produced. Aggregate weekly payrolls, as the name would suggest, it's like 70% of GDP, right? Consumption correlates incredibly well with nominal GDP, as you would expect. Okay? So The problem is you can't slow nominal GDP unless you weaken the labor market. And if the equity market leads the labor market, because we live in what we refer to as a hyper-financialized world, right? Literally the only thing that CEOs care about is their equity price, right? Up until a couple of years ago, we were punishing them if they made a profit, right? Doesn't matter. That doesn't matter. All that matters is you have them, your stock goes up, right? So the relationship is very simple. Stocks go up, CEOs fire. Stocks go up, CEOs hire. And stocks are rising. So where do we expect this slack in the labor market to come about from?
It makes us all a casino. We're all tied to the stock prices.
Correct. And the problem is since 2008, the correlation between the equity market and interest rates has gone negative. Because stocks are dictated by liquidity. They're not dictated to by rates. And who is controlling liquidity at the moment? It ain't the Fed. It's their old boss, Janet Yellen, who has a completely different job this year than she had when she was chairman of the Fed.
So who gets hurt more by the market slowly realizing that they will not experience as many rate cuts as
fixed income?
Right, it's fixed income that's going to get hurt more than the equity side.
Yeah, and I is it an epiphany event? I mean, it could be, but I suspect not. Right, I suspect this is a grinding. What you'll find is these rate cuts that are priced into the front end of the curve, will just gradually get priced out as we come up to expire. As we come up to contract expiries.
You don't think at some point the consumer is going to get choked, right? So some of the wage data we're seeing that's so strong is like government wage data. We're seeing 5 million people with 2 jobs, right? Like, so a lot of it is
tough. David, I look, 70%, I mean, no, it's more like 80% of all consumption, it happens anyway, right? And from a GDP perspective, it doesn't matter if they spend all the money on one object, or they've got all the money to go on holiday, or they've got all get spent on food. It doesn't matter. It all gets spent, right? It all gets spent. So from a GDP perspective, it doesn't matter. From sure, an equity, sector selection, it does matter, right? You want to know whether they're going on holiday, so you buy the airlines, or you want to know whether it's getting spent on food or rent or whatever, right? But it doesn't matter. It gets spent. But all the discretionary spending comes from the top 20% of people. And what have they got? Locked-in mortgages and enormous equity portfolios, which are going up. Right? Going up. Right, there you go, Dan. You give me the thumbs up. Did you sit there at Christmas and go, oh, sorry, darling, we're going to have to economize a bit? Right? No.
Well, no.
I didn't really give a shit.
Well, no, I cared.
I know you do, but I mean, most people don't, right?
Most fortunate.
I mean, if you go out to a high-end restaurant, you can barely get in. Well, you go to a high-end hotel, it's slowed down a bit.
Yeah,
but slow down a bit.
Yeah, and also that you've got bond portfolios that are generating income as well.
Correct. I mean, if you're an MMT, this is exactly what you believe, right? I mean, when you're running 100% debt to GDP, right, that's 5% that you just chucking back into the economy. Right, interest rate is high. We run a deficit, so a lot of that disappears to China, right, and Japan, but still.
So, Julian, how do you position yourself right now?
So, I think, look, this is quite a frustrating market, right? Last year was a tough market. Apart from that second half of the year where it was pretty obvious the economy wasn't slowing down, and then you just had to turn around and sell bonds. And we got lucky and we sold bonds at 4%, targeted 5%, and that was kind of the best trade of the year. I mean, right here, right now, my gut tells me that it's going to be more pain in the fixed income market. So we're looking at, various ways to play kind of corrections and repricing of those front-end markets. I think what's the imponderable, is how this Fed responds, because that will dictate what happens after that, right? Because if they do cut in the face of growth, then I'm just going to switch my bets from the short end to the long end and go short. Right? That's the only imponderable that you've got.
Yeah, I was going to ask something more like conceptual. I always struggle with the idea of, you were talking earlier about how the market is misunderstanding the real situation. So as a macro person who's making allocation investment decisions, how do you reconcile your view of the world with this idea that you don't agree with the way the market is interpreting the same macro data? And then, when you're making those decisions, do you go with what the market is telling you, even if you don't agree? Or you find yourself constantly a contrarian of some sort to like...
No, I mean, not constantly a contrarian. I mean, not constantly a contrarian. It doesn't pay to be constantly a contrarian. But, as David asks at the beginning, you kind of look for where you think the risk-reward trades are. I mean, at 200 basis points priced in, I have to price a pretty amazing scenario, right? To get that in, and I think we've priced that. So it's risk-reward. If I'm in the recessionary camp, then I just go and slot the stock market, because that's obviously the most mispriced if you go into recession. But if we don't go into recession, which is what my models are beginning to suggest, then in actual fact, there's a cyclical recovery, particularly in the manufacturing sector coming, which is a sector which the bond market historically has been very sensitive to, then I have to say that I think that the bond market is mispriced. Why? To go back to your question, is it kind of mispriced? Well, I think in part because they don't understand the policy framework that policymakers are operating in. Traditionally, if you look at tightening cycles in the United States and you look at the spread between nominal GDP and Fed funds, and why am I looking at nominal GDP? Well, when, as I said, unemployment is this low everywhere, it's kind of important not to just look at inflation, right? Because as I said, even if your inflation went to zero tomorrow, if your nominal GDP stays very high, your real growth accelerates and then you get wage pressure. That's why the Fed talks about wanting to see slackening of the labor market, right? So if you look at traditional tightening cycle in the US, Fed funds typically go to 100 basis points over nominal GDP, right? Well, that would put us at 7.25%, right? So they're clearly not pursuing that. That leaves one or two options. They're pursuing the mid-1990s, where they only fine-tune, and that's what I've been led to believe through policy contacts. And that's what they're telling you. They're telling you 75 basis points, maybe, right? But the market, as I said, we've got so used to this. Rates go up, rates go down, rates go up, rates go down. But they didn't in the late 90s because we were following a different policy framework. Now, if they'd taken rates to 7.5 and we destroyed the US banking system and the S&P was sitting at 3,000, sure, I'd be completely in the camp that rates are going back to 1%. Okay? But they haven't.
But isn't the difference this time exactly what you spoke about before? It's who has the balance sheet, right? It's not the government anymore. It's the households and corporations. So a greater percentage of homes than ever before, as you said, are locked up in 30-year mortgages. They have cash sitting in savings accounts getting 5.25%. And like there's some who argue in that dynamic that higher rates are inflationary. I'm not saying I agree with that, but I'm just asking your opinion on that.
Well, that's the you're going back to that MMT argument, right? Where you say, you're giving a transfer of 5% of GDP to the broad economy. Yeah, there's an element of that. It's true. But, it's much more powerful if you just, kick the S&P up 20% in the last quarter of the year, right? That makes people feel a lot more fuzzy than just getting a little 5%. God, 5%, that's pathetic. We're used to getting 15% on our money every single year, right? Because that's what the S&P goes up every single year, right?
But there's also a lot of correlation between duration and the Magnificent Seven, obviously less so last year, but in 2022 there was. So
Correct.
in this environment where rates aren't going down nearly as much as people expect and we're higher for longer, you still feel that it's like the 10-year treasury that would do worse than some of these.
I mean, look, I could see a situation where Janet Yellen, we run down the, let's say we get a little wobble, right? We think the equity market looks a little vulnerable here, right? It's expensive. We have this massive run up in Q4. Let's say we get a 38.2% retracement, right, of that run up, right? So you get sort of a 8 to 10% correction. Janet Yellen has no incentive to allow this economy to slacken, right? And she can slew, and she's shown herself incredibly adept at doing this, slew issuance to the front end of the curve, draw down the reserve repo. The moment that hits some sort of limit, either the Fed will have to stop QT, okay, or she can switch over and do the TGA, right? She's got $700 billion in that thing to run down, okay? And she's shown herself pretty good at doing that, right? She did that during the government shutdown, right? And then you can basically have government spending that you don't have to fund from the market, okay, for a quarter or so. And so much as I would love to walk in and see the equity market down 50%, okay, because as a macro guy, that's my greatest day. I'm a bond boy ultimately, right? And I want to see blood in the streets and people crying, right? And it's the most gratifying mentally to be a bear, right, when you get it right. Okay, because it's bloody easy to be a bull. You just buy and hold, right? Like every idiot tells you to do, right? Because no one's able to time. Except there's a whole industry that's all they do, right? That's all they do. And they seem to make a decent living on it. I've got some quite big hedge fund friends with quite big houses and quite nice planes and quite nice yachts, right? And they seem to be able to market time. But the whole investment professionals tell you can't market time, okay? So it's very easy to do that. But much as I would like to be able to do that, I look at next year or this year, and I don't see an overly bearish equity market unless we reprice, and even to some extent, even if we do, reprice fixed income.
So along those lines, exactly that point, are you most focused on credit quality, right? Because
not credit at the moment, because growth is still strong, Dan, right? I mean, right. Credit sold off last year, but it was purely a duration play. It was a bond play, right? We did some great trades on HYG, but, at the end of the day, credit spreads never widened, right?
No, they didn't.
Why would they? Right. Yeah, they've narrowed since the middle of the summer, right? And why was that? Well, because growth didn't slow down, right? You only get worried when you get unemployment higher.
Yeah, so that's all real interesting, and candidly, I'm a little bit shook up because you're saying you're hoping for blood on the streets, but that's besides the point. I get where you're coming from on that.
I don't think, as I said, I don't think we'll see. I do think, that when I look out 4 or 5 years, do I think the US equity market will perform like it's done again? And the answer is definitively no.
No, it won't. Yeah, it's
definitively no. I mean, this is
as a reminder, everybody really should be expecting, single digit returns.
No, I think it's worse. I think you're going to have I think actually, if you stay invested in the US over the next 10 years, you'll have missed massive opportunities elsewhere. I think this is a cycle. We're stuck in this reflexive kind of cycle in equities at the moment.
Yeah, I'm glad you bring that up because everybody is so focused on the U.S. markets. Let's pivot a little bit, talk about international markets, because arguably there's more opportunity there, but nobody's invested there.
Right. So,
but before you answer,
go ahead.
Isn't that? I feel like at the beginning of every year, the story is go international, diversify globally, and then at the end of the year, we'll realize all the performance was in the U.S. It's like this broken record we go through every January of this is the year of emerging markets. This is the year of internationals. So,
I would concur. But here's what I would say. I would say that when you look at when you look at the setup, it's an interesting one. When you go back and look at history, we're the reserve provider. So what does the reserve provider have to do? How do they provide reserves? Well, typically they run a large current account, a large budget deficit. That's how you provide reserves to the rest of the world. You can lend them to the rest of the world. But we've seen in the past with emerging market crises, they don't generally end very well, right? So we're obliged to run these very large deficits. What does that mean? So it means that we go and buy cars from Germany, cars from Japan, plastic dog shit from China, right? Whatever you want to call it, right? That's what we do. How do we pay for that? Well, we have to pay for it in their currency. So we can't, and that means they either have to lend us the money to do that, which they haven't been doing, or they have to buy US assets. Okay? And that's what they've been doing. And we're running record deficit levels, okay, is a percentage of GDP quite close to the sort of levels we saw in the dot-com bubble. And it looks to me that unlike 2008, where they funded that deficit, which was also very high, by buying, CDOs, and we all saw how that one worked out for the Landers banks, right? This time, like in the dot-com bubble, they've been buying equities. Now, the equities are better quality, but nonetheless, they've been buying equities to a large degree, right? We've gone from the US equity market being worth 40% of the rest of the world in 2014 to now being worth 85% of the rest of the world equity market, right? 85% of the rest of the world. Now, it can go higher, but there's another element as well, and there's the dollar. And because they have to fund these inflows unhedged, right? They can't give us the money to buy their cars and then hedge it. It doesn't work like that, right? They have to take naked dollar exposure on their Google, Amazon, Apple, Netflix, Nvidia holdings, right? So you have this three-legged stool, but it gets more interesting than this because it's a reflexive relationship in the true Soros-esque meaning of the word, in the sense that the purchase of the asset underpins the fundamentals that underpin that asset, and it becomes self-reinforcing. So, a few years ago, foreigners were looking at US corporate debt. US corporate debt was yielding way more than their own debt was when they were in negative interest rates. So they were piling into that. US corporations were taking that money, buying back their own stocks. So the US equity market was outperforming. So then foreigners were like, oh, I better have me some of that too. So you get this virtuous cycle. And it's a very powerful cycle, but when we saw it heading into 2001, we've seen it in periods in the past where it all looks amazing, right? Because as long as the flow comes in and the economy is strong and we need that money to finance that deficit because the economy is strong and the dollar is strong, wonderful. But if any one of those legs on the stool drops out, somehow we do go into a recession because the Fed does push it too far, then the money goes home because a current account deficit collapses because we're in a recession and the money just goes home. The second one is maybe the Chinese do come out with some alternative currency and the dollar just craps out, right? And the money goes home because Mr. and Mrs. Schmidt sit there one day and go, in euro terms, was my Nvidia stock done? Right? And then the third one is we find out we just have a bubble in the US equity market, right? And it collapses one day and the money goes home. So this is it's the definition of an unstable, stable equilibrium, but it's big and it's powerful. And as long as those dynamics keep the game going, fine. Right? Fine. But to answer your question, Dan, I don't think it's going to go on forever like that. My suspicion is at some point one of those legs is going to fall out. Not this year, probably, but
But so to circle back to the question about the, international look, the allocation, if you are making that decision, what does that look like? Do you bet do you bet on the unstable stability to continue? Do you go ahead and diversify aggressively?
I think if I said to you, you might be a bit surprised if I said to you, as a US investor, you would have been better off being in Euro stocks, in euros, so unhedged, right, from a US perspective, since October than you would have been in the S&P. Right? You actually are. Now, the fact that it's even kept up with the US, given all this AI, story, is, I think, incredibly impressive. Okay? So I think you have to start to look for opportunities, right? But the bit that's missing, and what will do it, is you need to see the dollar break down, right? You need to see the dollar break, because that is the ultimate arbitrator of, do we get that next global reflationary growth cycle? And then in that situation, there's a bunch of other stuff that you want to own that outperforms, because that relationship will start to get wobbly, right? I mean, if I said to you, was it a good trade to be long US stocks in 2002 to 2008? You'd go, yeah, it was a good trade, right? They went up. Yeah, it was a good trade. It would have been far better if you'd have long European stocks in euros. Massive outperformance, the rest of the world. Massive outperformance, right? Doesn't mean they have to go down. They just don't perform as well, right? I mean, literally 2002 to 2008, you would have been better off. I mean, you could have done it by doing sectoral selection in the US, right? But you'd have been long absolutely everything that you are currently long, and short everything that you're currently long, right? You would be short tech, short consumer discretionary. You would have been the healthcare. You would have been long transports, long miners, and long metals, basically.
So, Julian, how would you play Japan? Speaking of international, that's very well.
Yeah, Japan's traded exceptionally well. But not really if you look at it in dollar. It's starting to look like it's breaking out in dollar terms, and I think it looks like it was forming a head and shoulders pattern, and now it's breaking out of one of the shoulders early, which I quite like in dollar terms. We were quite big enthusiasts for we were measured enthusiasts for the BOJ changing. The problem is the earthquake and the politics, we think, has shifted the agenda. We wrote this probably as far as July for a move. So that kind of dampens our ardor a little bit on that one. But I have a level that I'm watching on Japanese stocks that I really want to get in, and we're not there yet. And that would be when I get in at the expense of being short the US.
Interesting.
Because what we had, Dan, if you look at correlation, sir, in the last quarter, we've just had an everything rally, right? An everything rally, right? Everything went up. So I know everyone was like, well, growth and, all these things. And yeah, wincy bit, the Russell outperformed, right? But if you looked at true reflationary trades, I mean, Christ, the NASDAQ is sitting relative to the Dow at literally its .com high levels, literally, which is the same level it hit during COVID, and it's there again. So if we were really seeing growth value rotation, as opposed to just an everything rally that we then go and fit a narrative to, it must be because they're ease and we're all going to buy, right? Then you'd expect to see some of that differentiation come through. And it's pretty hard to look for it, right? Why haven't gold miners outperformed gold? Why haven't silver miners outperformed silver? Why hasn't copper outperformed gold, right? All of those sorts of things. Why aren't we seeing those true reflationary trades? Because it isn't obvious it's there yet. What you just got And then maybe that comes through in the first quarter if I'm right about the manufacturing sector, right? But so far, all that happened is everything rallied. Correlation between bond and equity prices is back to 40-odd%. That's why risk parity and the balanced portfolio had its best quarter since 1990.
Yeah, we've got friends who are involved in that kind of strategy. So here's my question, though. We started off earlier talking about the Fed, and we talked about Janet Yellen as well. It's a little bit of a curveball kind of question, but we're ETF nerds. What is your thought process in the way that like Japan and now China are both buying ETFs to support their markets, right?
Yeah, I mean, it's an effective... Well, I think the BOJ did it for political reasons, right? You don't want to be seen... I mean, you are, obviously, because the way indexes are created, you're going to buy a lot of Apple if you did it in the US, right? You're going to buy a lot of Google and Amazon and whatever. But at least you can sort of keep your fingers clean, right? I'm not favoring any particular stocks or any particular companies, right? So I think there's a reason for that. It's quite an effective way of doing it, cost-effective way of doing it. These central banks haven't got a bunch of equity lines. If it were the good old days where you didn't have to disclose where you filled an order when I started in the business, oh, good God, could you imagine the markups you'd be getting if central banks tried to buy single-name stocks? The bonus pool on the equity desk that year would be really good. So I think that's why they've done it.
So what is this magical moment between the dollar and the yen and the US and Japan that, like, besides for a price level on Japanese stocks, like,
well, I'm
really
looking
just like the dollar and the yen unwinding? Is that really?
No, I mean, I look, I don't know if I can share a chart. Can I share a chart on the screen? No, I'm not allowed to. If you pull up the Topics Banking Index and you put it in dollars and you take it back to, you take it back to 19, how far does it go? Come on, Bloomberg. Sorry, it's being a bit slow. 1991. Okay. You will see a pretty clear level at $2. We are at 180 at the moment for that Topics Banking Index. It has acted as support, actually, really, in fairness, since 1998. Okay, so 25 years. Support and resistance. And it's certainly acted as resistance 1, 2, 3, 4, 5 times since 2009. It is a beautiful piece of chart porn, right? If you break that level, the next stop from 2 is slightly above 4.
Yep.
So if you have to watch closely so much data, I always wonder this, in your quest to be ahead of global markets every day, do you ever take a vacation? Like, are you taking your laptop to the beach? I mean, how do you manage day-to-day life when you cannot look away because the chart may move just then?
Kind of hard.
I love you, Cynthia.
No, I mean, look, Christmas is fantastic, right? Market shut down, and I didn't really look at a screen for the best part of 2.5 weeks. It was delightful. I have a very good team of very experienced traders and people. Even though we run an alpha capture platform, I'm not the one trading it. So I'm kind of lucky in that sense. But I generally do not go a day without sitting down in front of my desk.
I guess respect.
As I said, I could have picked easier things to do. Okay, but I don't play golf, right? So, I only have one passion, which takes a lot of practice, and that's skiing. And I'm going to exercise that in the next, few weeks. So there you go. That's about, and you do that. I do that on the West Coast. So the time zone, come the afternoon, everyone's finished anyway for the day. So that's fine.
Are you trading all day, or like, is your team trading all day?
So we're managing risk on our Alpha Capture platform. Yes, we are. I mean, not all day, but yes, we're watching markets all day. We get in the morning, we have a 7:30 standard morning meeting, every single day without, day in, day out, irrespective of where you are, you're on the call. If after that there's nothing to do, then go away. But that's what I expect.
And I always wonder, when people have strong views, what their risk management process is in terms of how much risk do they take pursuant to those views. I mean, do you?
No, I think look,
like 1%, 2%, 3%.
I mean, we don't. You're missing. You're kind of trading a percentage of your risk tolerance. Yeah. So if you say, look, and it doesn't really. I've got a client who says, look, I lose 10% a year. Right. That's what I'll allow myself to do. So if I'm up 10%, then that's fine. I could just swing a bit more, right? And I think you have to start off that way. We don't have I certainly, from a PA perspective, don't have it's January, I have to reset everything kind of button, right? But in the portfolio, we do manage it to some degree to that extent, and you have to be circumspect, right? So at the moment, we think the market is quite heavily mispriced, but it doesn't trade well in terms of, we think yield should be higher at the front end. It trades quite the opposite. So, and my suspicion is that there's quite a lot of macro people who think the same thing. And so, for example, today, into the data, there were actually a lot of put gamma in fixed income out there. So, you get exactly the right number, right, that you'd want if you're a bond bear. But if everyone's got the gamma on in that direction, the bloody thing doesn't move your way, right? So you have to wait another day. So I think, Dan, you have to really temper your positioning, not only based upon how far you think the market is mispriced, where you stand in P&L, but how the market's trading, right? How the market is trading. And it's not trading favorably for bond bears at the moment, right? It's not trading badly, but you're not making lots of money when you should be, right?
So without rates being really low in 3, 4, 5 years, a repeat of what we saw previously, are we really going to have any time in the next 5 to 10 years with a positive yield curve? Because if you have rates at 3.5%, 4.5%, 5.5%, and any investor can get a 1% spread on that out of 10-year, my guess is, with all of this wealth that's been created, that the boomers who have sat around with their financial advisors for 20 years trying to figure out like a 3% distribution rate, they're like, 5, I'll take it. Yeah. Right. So are we just like forever destined to not have a positive yield curve until rates go?
Look, I don't know. Look, firstly, I am a structural bond bear, right? I am a structural bond bear. I think, absent COVID, the low in bond yields occurred in 2016. And for the next 30 years, based upon demographics and based upon a shrinking pool of global savings, right? Let alone that we're trying to shove an insane amount of issuance down that shrinking pool's throat, bond yields are rising. I think that puts us in a structural world of pain eventually. So, I look at this sort of stuff and I go, does the Fed construct a positively sloped curve? At some point, are they forced to construct a positively sloped curve? Maybe, David, right? Maybe. They can do what they want. They will do what they want. It just has consequences. And I would argue that if they construct a positively sloped curve, like this time, if they are going to deliver, if I'm right and the data is picking up and the inflation is sticky, I'm not saying, please don't get me wrong, I'm not saying inflation is going back to 9% or whatever. I think it just looks like it's very sticky around this sort of 3.5 to 4 headline. Cornwall base at around 3 and change, and then looks like it's moving back up again as well in that sort of range, that we're going to settle at levels that we just are not commensurate with their objectives, okay? If they still choose to cut in that environment, for whatever reason, that it has consequences. And my guess, that would be the dollar. And I think that's a very, very, very dangerous game that we play. I hope they're not thinking, I think it is a Rubicon event if they do it.
To weaken the dollar.
No, I think you will weaken the US, structurally weaken the US. As I said, I think this is an economy where our equity market is built upon this very, very unstable, you knock the dollar leg out and it will crumple like a pack of cards. Best case scenario, we just underperform the rest of the world for the next decade. But it isn't, I worry about the motivations of the likes of China and Russia and the BRICS, right? I do worry about that. I'm not a Machiavellian, but I am a geopolitical history buff, right? And these are not good things to do, right? We do have to finance 3 wars. We've got a Cold War with China, which could turn hot at any point. We have a hot
Hopefully in the next 5 years, right?
Yeah, we have a hot war with Russia, and we're fighting a climate change war. The amount of money that we need to spend is astronomic, right? Astronomic if we hope of winning those, right? I think that the steps 5 years from now that governments will have to take will make people's heads absolutely bloody spin. And if you're old enough and you realize that we didn't have free markets until, certainly in currencies until the 70s, right? There were reasons because we had to get shit done in the 50s, 60s, right? That demanded government intervention. And if you don't think that they could turn around when the treasury yields are under pressure because we're still trying to fight these wars and we are running these enormous deficits and the world doesn't want to finance them because they're aging too and they're demanding their savings back so they can live in their retirement, right? Because that's what the Japanese have put their money in, right? They put their money in treasury so they can retire comfortably, right? When they start to draw down on those savings, who's going to buy that? Same as the Chinese. Who's going to buy that, right? They're all aging out. Who is going to buy that, right? If you don't think then at that point the US government doesn't come in and go, got this really nifty little idea, right? You've got life insurance companies, pension funds, you've got these 30, 40-year liabilities. We think we're going to pass a piece of legislation and you've got to match that with a 30-year, 40-year asset. And we've got a beaut for you, right? And that's how you get financial repression, right? All of this shit is going to come through, right? My big problem with crypto is not that I don't think it'll be a great trade. I think it could be an amazing trade. I just fear it's going to be too good. Because inherently built into the system is an ability to avoid the system, I think this is the one that ends up being the gold of the 1930s, the 1920s, where they turn around and go, we don't really want you to have the ability to shift money outside the US. We need the money here. So we're putting exchange controls in. And crypto at that point gets banned, or you can only trade it inside the US, right? You can't use the system to get outside.
Yeah.
I mean, this sounds like I'm being a lunatic.
No, I don't.
And I'm not saying this is. Please don't get me wrong. This is not today. This is not the setup. This is not what I'm trading.
Right.
But if you look at the trajectory of things, this is where we could easily go. There's no fiscal rectitude in DC. We tinker around at the edges. No one wants to cut healthcare or entitlements or defense spending. We need to bump up defense spending. We've got to pay those entitlements because we're all retiring, right?
And Julian, you and I don't want more Social Security, right, paid to us. Right.
I do. Screw it. I paid in the max. I want the max out.
Julian, this has been great. We really appreciate your insights, and the dialogue's been wonderful. Even if, quite honestly, I didn't want to hear some of it. It was a little bit scary, but it is reality. That's just a simple fact, right? We have to all think through that there are consequences.
Yes. I mean, look, I say to myself, look, I never want to get involved in politics. Like, people can do what they want, right? They can make decisions. It just has consequences, right? Donald Trump broke the seal on fiscal rectitude, right? He took it out into the garden shed and he shot it through the forehead, right? So he adds 8 trillion onto the deficit, and then Biden adds 12, right? So we've gone from 14 to 34 in a heartbeat.
So, David, what do you think? Should we nominate Julian for president?
We should. I'm gonna go sell everything right now.
No, David, no, please. I don't think Janet Yellen lets this equity market drop more than about 10%.
I will say, though, I think from a democracy standpoint, you're right that whether it's the president or the head of the Fed or anyone, every time there's a crisis, we take this added step of, okay, now we need this control power to protect against that. And the next person never undoes the power of the last person. It's just an additional quiver in their tool set, and you just kind of keep building on top of it over and over again. And here we are in 2024.
And look, there are very good reasons. I mean, this is referred to as fiscal dominance, right? You slip from monetary dominance, this is what we've enjoying, to fiscal dominance. And fiscal dominance tends to be the dominant policy during periods of societal need. Let's put it like that. You're fighting a war, you're fighting some sort of, you're faced with some existential risk, okay? We're faced with all of those. It's totally justifiable. We just as investors got to understand how we can try and avoid some of the consequences of those moves, right? Maybe we'll all have to buy war bonds again, like we did, like our grandparents did and our great-grandparents did, right?
Well, I'm going to suggest we start by buying a round of beers right now, Julian. I don't think I can take any more.
Thanks, everybody.
We
appreciate it.
I'm long gold, I'm long silver. I've got, I'm still long, some stocks, not all the necessarily fashionable ones, but I'm definitely invested. I'm just not buying bonds. I'm selling bonds.
Cynthia, it's been great. David, awesome. Julian, thanks for your insight. We appreciate it.
Pleasure.
Julian, it's a pleasure. Thank you.
Have a good one. Thanks, chaps. Bye-bye.